Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how to profit from interest rate futures in 2024. Understanding interest rate futures, a guide for investors in 2024. Ever wondered how traders protect themselves against the wild swings in interest rates? Enter the world of interest rate futures, a financial instrument that's essential for anyone looking to hedge against interest rate risks. These contracts promise a future exchange of an asset with terms defined in the present, offering a glimpse into the financial pulse of tomorrow. Interest rate futures are more than just sophisticated tools for seasoned traders, they're central to the strategies of financial pros managing portfolios. Understanding how these contracts work can unlock new strategies for profit and protection in an unpredictable market landscape. In this video, you'll learn what makes these futures tick, why they matter, and how they can be used effectively in trading strategies. What are interest rate futures? Interest rate futures are like a crystal ball for the financial markets, allowing investors to predict and manage future interest rate movements. They are essential tools that help everyone from banks to individual investors hedge against potential rate changes. But what exactly are these futures, and how do they work? Let's break it down in simple terms. The basics of interest rate futures. Interest rate futures are financial contracts that allow investors to bet on the direction of interest rates. These contracts are based on the value of an underlying asset, typically government bonds or other debt instruments. Here's a closer look at the core characteristics. Underlying assets. The most common underlying assets include treasury bills, treasury bonds, and eurodollar deposits. These are stable and widely traded, making them ideal for futures contracts. Contract specifications. Each futures contract has specific details like the expiration date, the notional amount, and the interest rate it's tied to. These specifications standardize the contracts, making them easy to trade on futures exchanges. Interest rate futures are pivotal because they give investors a way to lock in current interest rates. If you're an investor, it's like having a weather forecast that helps you decide whether to carry an umbrella or sunglasses. Types of interest rate futures. There's a wide variety of interest rate futures, each serving different strategic purposes. Let's explore some of the most commonly traded types. Treasury bond futures. These futures are tied to government bonds with a maturity of more than 10 years. They're incredibly popular, offering a way to hedge against long-term interest rate fluctuations. Eurodollar futures. Despite the name, eurodollars are US dollars deposited in foreign banks. Eurodollar futures are contracts that let traders speculate on the path of short-term interest rates for these dollar deposits. Treasury bill futures. These are short-term securities that are usually issued for a year or less. Futures based on treasury bills are perfect for investors focused on short-term interest rate changes. These futures are like different tools in a toolbox, each designed to handle specific job, managing risk in different segments of the interest rate market. Whether you are looking to safeguard against short-term rate changes or focusing on long-term shifts, there's a futures contract to meet your needs. The utility of interest rate futures extends beyond just hedging. They are also crucial for speculating on market direction, providing liquidity, and helping in price discovery. Understanding these futures can be your first step in navigating the complex world of interest rates with confidence. Importance of interest rate futures in hedging. Interest rate futures are powerful tools that help investors and businesses protect themselves from the unpredictability of interest rate changes. It's like putting on a raincoat before stepping into a storm, you're prepared for whatever comes your way. These financial instruments allow you to hedge against potential losses when interest rates soar or tumble. The question is, how do interest rate futures play such a critical role in safeguarding your financial well-being? Reducing interest rate risk. Interest rate risk can be an unwelcome guest, affecting everything from your personal finances to large corporate borrowings. By using interest rate futures, you can mitigate exposure to these fluctuations. Here's how. Lock-in rates. Interest rate futures allow you to lock in current rates. If the rates increase in the future, you have already secured a favorable rate. Think of it like fixing the price of a game before it becomes the season's hit. Hedging strategies. Investors use various strategies like buying or selling futures contracts. For example, if you fear rates will rise, you could sell interest rate futures to offset potential losses in your bond holdings. Budget predictability. By hedging against interest rate changes, businesses can maintain stable budgets without worrying about rate-induced cost spikes. It's a way to keep your financial house in order despite outside chaos. Engagement tip. Have you ever thought about how even small interest rate swings can impact your daily living costs, like your mortgage or car loan? Portfolio management with interest rate futures. Managing a portfolio isn't just about chasing high returns, it's about balancing risk and reward. Portfolio managers often incorporate interest rate futures to strike this balance. Risk management. By integrating interest rate futures, managers can fine-tune the risk profile of the portfolio. It's akin to adjusting the sails on a boat to navigate smoothly through changing winds. Return optimization. These futures help maximize returns by allowing managers to reposition investments based on interest rate forecasts. This means more potential for growth without unnecessary risk. Diversification. Adding interest rate futures can diversify a portfolio, reducing overall risk by spreading exposure across different types of investments. Think of it as adding more layers to your financial safety net. Reflective prompt. Are you using all available tools to keep your investment portfolio secure and thriving? Interest rate futures empower investors and portfolio managers alike to face the financial landscape with confidence and foresight. By understanding and leveraging these tools, you can navigate the tumultuous seas of interest rates with greater ease. Speculation in interest rate futures. When it comes to trading interest rate futures, speculation plays a crucial role. Speculators aim to profit from changes in interest rates by predicting future market movements. While this can be rewarding, it also involves significant risk. Understanding how speculation works in interest rate futures can help you get a better grasp on these financial instruments. Market strategies for speculators. Speculators often employ a variety of strategies when trading interest rate futures. These strategies are designed to maximize gains while keeping potential losses in check. Here are some common approaches. Trend following. This involves betting on the continuation of a trend. If rates are rising, a speculator might buy futures hoping the trend continues. Contrarian strategy. Some speculators go against the crowd. If everyone is buying, they might sell, believing the market is due for a correction. Spreads. This strategy involves buying and selling futures with different maturities. The aim is to profit from the spread, or price difference, between the contracts. Technical analysis. Uses charts and patterns to predict future movements. Speculators study past price movements to forecast where rates might head. Each strategy has its complexities, but mastering them can make a big difference in trading success. Risks associated with speculating. Speculating with interest rate futures is not without risks. Unlike investing, which often focuses on long-term gains, speculation aims for quick profits. Here are some risks to consider. Market volatility. Interest rates can be unpredictable. Sudden changes can lead to rapid losses. Leverage. Futures allow you to control a large position with a small amount of capital. While this can amplify gains, it can also lead to significant losses. Timing. Getting the timing wrong can be costly. A market might move as you predicted, but if it happens too late, you may face losses. Economic events. Interest rates are closely linked to economic indicators. Events like Federal Reserve announcements can drastically move markets. Being aware of these risks helps speculators plan better. It's like walking a tightrope. One needs balance and preparation to succeed. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.